Welcome to Chapter 2 of this series for basic options. In the first chapter, we went over the concept of options. You learned that you could buy a call if you think the stock might go up, and you could buy a put if you think the stock might go down. But at this point, it may still be an abstract concept to grasp. Stick with this and it will get clearer. Option contracts aren't actually physical pieces of paper. It's all done electronically. You can trade an option contract with your broker within a few milliseconds at the click of your mouse. It's just like buying or selling stock. What you are looking at currently on the whiteboard is what is called an option chain. An option chain is simply just a list of all the options that we can trade for the specific underlying. It also shows the price of each of these options, along with other data like the strike price and contract expiration. Other data like delta, theta, and other Greeks can be added if not already available on your broker's chain. We will go over the Greeks later on. You can find an option chain in your trading platform and also a few different places on the web, but the one we are looking at right now is on our trading platform, tastytrade. You can find a link to open a trading account with our favorite broker in the video description below. It's an incredible trading platform for options and other assets like futures. An option chain shows you all of the available options for the underlying and the prices for each, along with other data that we'll go over later. Most of your favorite companies that have stock also have options. To see if a stock has options, all you have to do is type in the ticker symbol. If it does have options, you will see the data listed below, and if it doesn't, then no data will be listed. So let's just look at NVIDIA stock options by typing in the ticker symbol NVDA. You can see there are many option contracts that we can trade, and there's actually so many that it might seem overwhelming at first glance. But don't get intimidated. We're going to explain this in the simplest way possible. Before we get into why these option prices are what they are, we're going to go over some very basic characteristics of options and also show you how to even read this option chain. First, we have to select our expiration. The expiration date, if you remember, is simply the date that the option contract will expire. So on the left side, you can see there is a list of all of the available expirations. What you're looking at is the actual date that they expire, and the number in the center here simply tells us how many days are left until that expiration date. So clicking on this expiration date, for example, will show you all of the options that expire on the 18th of September 2026. And you can see here that that date is 62 days from now. Remember, we are still covering the very basics, so we're not yet going to go over which expiration you should be trading. There are pros and cons to choosing different expiration dates. You will learn about this later in the course. For now, it's important to get the basics down. So we're just going to choose the expiration date with 62 days left. Once you click on the expiration date, you can see a whole list of options for that expiration. On the left side, you will see the call options that expire on this date, and on the right side, you will see the put options that expire. Now we just have to choose our strike price. The strike prices of each option are listed vertically through the center of your screen. Now, just like with selecting an expiration, we also have to choose our strike price of the option we want to trade. We aren't going to get into which strike you should be trading until later, but for now, let's just choose the 235 strike call option. Okay, so that's it. We know how to navigate the option chain to find a certain option. You can find a call option or put option with a certain expiration date and a certain strike price, but you can also see the price of each of these options. Just like stock, options also have what is called a bid price and an ask price. And we're going to assume that you already know what the bid and ask price is. If you want to buy an asset, you're going to have to buy it at the ask price because that's where the sellers are. And if you want to sell an asset, you're going to have to sell it at the bid price because that's where the market is willing to buy it from you. Simple enough, right? We'll go over buying and selling at the mid price to optimize your trade later. Now let's move this option off to the side. We'll move on and talk about its pricing a little bit and what it would actually look like if you wanted to trade this option now. Stocks trade in shares, but options trade in contracts. One option contract is going to control 100 shares of stock. Remember, a call option gives us the right to buy stock at its strike price at a later date. So if we wanted the right to buy 100 shares of stock at a later date, then we would have to purchase one option contract. But if we wanted the right to buy 200 shares of stock at a later date, then we would have to purchase two contracts. That's what we mean when we say one contract controls 100 shares of stock. So let's just say that we wanted to purchase one contract of this 235 strike call option. How much money would this actually cost us? Well, looking at this call option, you can see the bid price is $4.50 and the ask price is $4.65. So to buy this option, we would have to pay the ask price of $4.65. But here's the thing to understand. It's actually going to cost us $465 per contract. This is because one option contract represents 100 shares, so option prices will have a multiplier of 100. Now we know this may seem confusing, but you will get used to it with practice and time. One trick you can do is just think of these prices without the decimal point. If the price says 4.85, just remove the decimal, and it's really going to cost you $465, just like stock prices ebb and flow each day. Option prices also fluctuate and move around each day. In the next chapters, you're going to learn about what causes option prices to fluctuate and why they might go up or down in price. But for this example, let's just say we bought one contract of this call option at $4.65, so we actually paid $465. Over the next week or so, let's say the option price goes from $4.65 up to $5.82. Now, just like trading any asset, we constantly have to make decisions about when to sell. We could, of course, hold this and hope it gets higher, but let's assume that we have decided to sell this option and take our profit. So we close this position by selling the call option that we own at $5.82. So if we bought something for $485 and we sold it for $582, it's pretty clear that we made a profit of $97, returning 25% profit on our capital that we risked on the trade. Not a bad return on our investment. Now let's look at one more example for practice. Instead of buying one contract of this call option at $465, let's say we wanted to purchase two contracts. The concept is the exactly same here. We're just purchasing twice as many contracts. So if one contract cost us $465, then to find our cost of two contracts, we would simply just multiply that by 2. So two contracts would cost us $930. If the price of the option goes up and we can sell both of our contracts at $582, then that means we turn $930 into $1,164. So our profit would be $234. Again, there are 3 factors that would cause an option's price to move up or down, resulting in a profit or loss. The first factor that causes this we vaguely went over in Chapter 1, and that is the movement of the underlying stock price. The price of a call option will typically go up in value. If the stock's price goes up, then the call option will go up. The price of a put option will go up if a stock's price goes down. To put it simply, if you buy a call option, you are betting that the underlying stock's price will go up, and if you buy a put option, you're betting that the underlying stock's price will go down. But remember, there are also 2 other factors that affect an option's price, and they are extremely important. So don't go buying options just yet. You're going to learn about these soon. Now, before we move on, let's recap what you've learned in this chapter. You learned what an option chain is. It's what you'll look at to find all the listed options and their price quotes. You can find an option chain in many places, but you're probably going to want to view options on your trading platform provided by your broker. You also learned that, like stocks, option prices have a bid and ask price. You learned one option contract controls 100 shares of stock. In the next chapter, we're going to go in pretty deep, and you're going to learn the 3 factors that cause an option's price to change. This is where it gets interesting. Up till now, I know it's been pretty boring, but it's important to know the very basics if you're just starting out and want to take trading seriously. Having this knowledge base will help you moving forward with trading options. Knowledge that will allow you to start learning strategies to profit from option price changes. There are many ways to profit from options other than buying them. These videos will help you learn those, and they are completely free. Be sure to watch the next videos in this series. Okay, on to the next chapter. Thanks for watching, and if you found value in this video, please like and subscribe. Thanks again.